What is up, everyone? This is Warren Howe. Hope you're having a great day out there. Now, in this video, we'll be talking about 5 things I wish I knew earlier before I began my stock investing journey. For those of you that have just started out, hopefully this video finds you well. I legit started my I opened my first stock account since 2008, and I seriously wish I knew these things before I started out, because there's no one guiding me. For those of you that are just starting out your investment journey, hopefully this video finds you well. Hopefully it provides you some value, and let's get to it. But before that, you guys know the drill. Show a brother some love. Smash that subscribe button if you haven't, because for Academy, we are here to empower you, to basically level you up in the stock investing game. We combine FATA, which gives us an edge, fundamental analysis and technical analysis, to maximize our portfolio gains. And yes, that is me sitting on a bear to conquer bear markets. So again, appreciate it. If you like this video, smash that like button, and we can go through. Yep. Now, the first thing I wish I knew before I began my stock investing journey is basically focused investing. This is a very important aspect, because focused investing, especially on our winners, now it takes time to identify which are your winners, which are your losers, and I'm not talking about just stock price. You can have your winners down 50% and you can still be a winner as long as you have all the fundamentals in place. Now, focused investing, if I practiced that more, I would have maximized my portfolio even more and own more shares, but a little about that later. And another thing is combination of FATA. I wish I had combined my skills of FATA back then, because I could actually make more shorter term plays to raise more cash instead of having to just work my ass off and get gains from my income. I could actually have better cash flow revolving plays, thematic plays, be more in the market and getting myself educated to be more and capitalize on shorter term movements, capitalize on weakness, inefficiencies. That's what FATA is for. For Academy equals FATA, right? That's the name of the game. So let me elaborate more onto that. But first, let's talk about focused investing. For those of you that are just starting out, right? Let's say you have 3,000 in your stock portfolio. Does it make sense to own more than 10 stocks, 15 stocks, or even 20 stocks just for the sake of diversification? I can tell you right now, it does not make sense. Because let's put it that way. If your portfolio goal, and by the way, we should have portfolio goals, we should have portfolio strategy before we even begin investing our hard-earned money. Let's say your portfolio goal is to have 2x in 3 years, and also let's say every time you have good sufficient savings from your income, putting more into the stock market, let's say you can put in 300 every month. 300 itself is really 10% of your stock portfolio. Now, does it make sense to have 20 stocks? That means on average, you'll only own 150 per stock if your cash injection is so healthy. It does not. So let's say your portfolio goal is 2x in 3 years. Also, if you own 20 stocks, technically, on average, you need all of these 20 stocks to 2x to be able to bring you to where you want. Now, of course, every basket, there'll be good eggs, there'll be bad eggs. We'll be God if we can actually have all of these winners, 100% winners, to be for the long run, right? I had bad eggs. I had really bad eggs. I mean, I lost a lot of money last time. I paid a lot of tuition fees. But my point is, focused investing works, because if you identify your winner, whether they are a disruptive company, they are a high growth company, they have good management, they can bring you to where you want to be in the future, that's where your majority of your money should be, because you have built high convictions on this high conviction stock, high growth stock, whatever it is, and you want to be owning more of that piece of the business. Yeah. So on average, all of your 20 stocks must 2x. What is the likelihood of all your stocks 2xing? Because there's definitely going to be a few losers. You're going to take some L's of these 20 stocks. So what is the likelihood of all of these 20 stocks actually having the 2x to bring your portfolio to 2x? And having only an average of 150 per stock just doesn't make sense. Yep, that's too little. Your cash injection is more of 10% every month. You're owning 5% of each stock. So if that 5% stock actually goes up 100% in 1 year or 2 years, which is highly unlikely for all of them to do so, that will only contribute a capital profit of 5%. How did I work that out? 100% of 150 is 150. 150 divided by 3,000 is just 5%. Yep, 10% is 300, 5% is 150. Now it doesn't make sense because imagine if that high growth stock is like Tesla, a valuable stock that goes up 200% in 3 years, and all you got in them was just 150 bucks. Now again, it applies to any stock, right? Let's say if it's a loser, then you could say, hey Warren, I have just 150, I lost lesser than I should. Because if let's say it went down 50%, then yeah, you are not so diversified. But that is the beauty of having focused investing, and that's the beauty. Before you even pile more onto that winner, we should be having building high convictions on these stocks, right? So once you build strong convictions on your business, own a majority chunk of them. Own a majority chunk, because that's how it works. Hold on to the stock and pile on more into this winner. The concept is to be owning more shares of this winner. Yep. And I'm not talking about winners from share price. I'm talking about fundamentals. Yep. So in the portfolio, the public portfolio, which we also highlighted in previous videos, our portfolio goal is to have 60% in long term, because it's a 3,000 account, 40% on momentum, thematic, swing plays, cash flow revolving plays. The idea, the concept is to be building more cash, raising more cash. And the goal for that is to be adding 300 to 500 every month. Now, so far, it's actually losing money, unrealized gains, unrealized losses. But you can see that I'm practicing focused investing. My high conviction stocks are on SoFi. My high conviction stocks are on Tesla. I'll be building more and more along the way. But in the meantime, I'm comfortable with 40% cash, just to be capitalizing on, let's say energy or any other sector or stock that I think is deemed to be good. So far, I've had gains, but the unrealized losses so far in the long term is actually eating it up. But again, I'll just be working harder and harder for my momentum plays. Yep. So flexibility to move in and out of trades. 40% of my portfolio, the goal is to raise cash and to be adding more into Tesla, especially Tesla and SoFi. Yep. And, focused investing wouldn't work, and I wouldn't have this 585% TWR returns for this bigger public portfolio that I had since 2019. It wouldn't work if I didn't do focused investing. Now, what were the focused investments? I did Tesla, definitely, right? Tesla, Catel, thematic plays were on Carnival Cruise Lines, Lum Research, right? All these EV stocks, Cheesecake Factory, all of these stocks would be contributing into these gains. Especially, and we reviewed this before, we have had several gains on Bursa, right? Malaysian stocks, and that's where we can actually hedge on different market sentiments and capitalizing, since on warrants, on gloves, on tech stocks, all of those gains in and out were fueling the longer term, and that's where I could buy more of my longer term shares. I could buy more Palantir, my Tesla, whatever. Yep. So this stock account just began with 2,300. Yep. It was a 2,300 account ever since 2019. So far, also there were deposits. Majority of the chunk was for gains from Bursa, right? Malaysian markets, and that's where we fueled in, to the long run. Yeah. So this is the history of it. 585% returns. It is the long-term plays that cushions your portfolio and gets you owning a piece of the business. It is the thematic short-term plays that gets your portfolio fueled and built with more cash. So I wish I knew focused investing back then. I wish I knew FATA back then. Yep. Now, number two of this is basically aim for capital G stocks. Now, this is relative to what we said just now, but aim for capital G. Dividends are great. But why limit ourselves to 4 to 5% per annum? Now, I'm not trying to say eliminate all of your dividend stocks, but if you are actually, if you just have 3,000 if you are controlling a 3,000 portfolio account, does it make sense to have 4 to 5% per annum and lesser on capital gains? Yep. So I'm going to walk you guys through memory lane a little bit, because this was a company that I really loved last time. Ever since I began my investing journey, this will always be in my mind. Yep. I love dividends. Yeah, let's put it that way. I love the idea of not working, actually, sitting down and raising, getting dividend gains. But the point is, it does not work we should actually focus on capital G, which is capital growth. Yeah, growth stocks. Simply because the capital gains that I had on Sunray, if I compared since when I bought it, which was 95 cents ish, that capital gain would just be 57% capital gains in a decade. more than a decade. Yep. Now, that's where focused investing also comes in. That's where, opportunity cost comes in. Yeah, opportunity cost is basically losing out on potentially higher no-brainer stocks rather than dividend investing. Now, I'm not trying to say don't go into dividend investing, but there's a reason why growth stocks should actually make it over the long run, dependent on their fundamentals. So SunRate, it's a real estate investment trust. They have shopping malls, they have hotels, and basically they generate rental. And how rates work is that 90% of those rentals are actually paid to shareholders in the form of dividends. So that's where I love rates, because I'm getting 4 to 5% a year. That makes sense if I have $1 million, but I didn't. So that's what I'm trying to say. Now, overall, again, the capital gains that it provided in more than a decade was 57%. And I had 4 to 5% dividend yields per annum. So the good thing is, we can actually, if I invested 10,000 ringgit at that time, I had 5% every year. That's great and all, but if we were to compile that and compare that with growth stocks, we would eventually lose out in terms of gains. Now, before that, I was also a fan of Dogs of the Dow. So cute, this dog, yeah. I was a fan of Dogs of the Dow, and Dogs of the Dow, the concept was basically highest yielding dividend stocks. Yep. The concept is to buy each equal dollar amounts and just hold over the year, right? Because the gain is the game plan is to actually have more gains from dividends. Yep, dividend yields. So, but if you're actually controlling a $3,000 account, 5% of that a year is 150. Yep, that's the concept. It's not as much. You could be arguing and say, okay, let's reinvest the dividends, right? You'll still be, piling on more cash and saving more income every month and be just piling on more. And that works, yes. But how is that versus, that's where fundamentals come in. Does it make sense to be piling on more to dividend stocks, especially if the company is higher up into the S curve and actually having lower growth? There might even be a value trap, and the capital gains might even go lower, regardless if you have high dividends. Now, how high can your dividends be? Some dividends can be 10. There wouldn't be any stock giving 10% unless it's a bad egg, to be frank, right? That's how they attract shareholders. That's how they attract investors. So how high can your dividends be? 4%, 5%? Dogs of the Dow are actually concentrating on Dow stocks, and maximum dividends paid out there is probably 8% or 7%, right? So my point is, with low capital, if you're just starting out, dividends are great and all. That could be in the later game plan where you've been raising a lot of cash, probably earning from your high growth stocks. Then you could be actually piling onto dividends, yeah? And if you were to compare Google, now the reason why I say Google and I compare Google is because a lot of people, they probably had doubts on Amazon, yep, which I regret until this day. Ever since they have had AWS, I should have invested in them. But anyway, what's done is done. But the reason why I've been comparing Google is because Google back then and till today is a no-brainer stock. Yep. Little can be said about Tesla because they have had no traction, no progress back then. They were nearly bankrupt. But Google, on the other hand, is a no-brainer, easy to compare growth stock, right? Everyone is using Google. Now, if I just take 2012, which I'm actually comparing the timeline where Sunway Rate was actually listed, it would actually provide in that similar time frame, it would actually gain 774% in capital gains. Now that means a 1.5K account. Why 1.5? Focused investing means investing probably 50% on your high conviction stock, and 50% of 3,000 is 1.5. So 1.5 will turn into 13,000 in a decade, when if you just, double up in, Sunway Rate would just give you 2x in 10 years, which is a no-brainer in this case, right? So that's where capital G comes in, that's where capital gains comes in, that's where focused investing comes in, and that's why we should be focused on growth in revenue, growth in earnings, growth in R&D, and their drive to grow shareholder returns. Yep. So moving on to number 3, basically broaden our horizon. Yeah, broaden our horizon. We are not limited to just one stock market, one burst. We're not just limited to Malaysia. we should not be just limited to the US. We should be learning and improving our knowledge, basically broadening the horizon and capitalizing on weakness, because every country has their calamity, every country has their dilemma, and that's where we can actually ride on, capitalize on inefficiency, right? And also it trains us to be better investors. Yep. So invest overseas and be a growth whore. Yeah. So what do I mean by that? Last time I was limited to just Malaysia. Yep. I never really liked Malaysian stocks all that well, but I can't argue, because there's growth everywhere. There's growth in Malaysian stocks. There are gems in Malaysian stocks. There are gems in US. There are gems in China. There are gems in Hong Kong. All we need to do is just to be studying them, right? So invest in overseas, as treated as a means of diversification. I wish I knew that last time, right? I wish I invested more into US growth stocks, because if you bring back the stock price chart, and I don't really like to do that, but in terms of market cap gains, in terms of value created for shareholders, there's no comparison when it comes to Coke, branded goods, Apple. I'm in this part of the world and I'm consuming US goods, right? I'm using Microsoft, I'm using Apple, I'm using all these products. So Tesla, all these companies. So what is the reason why these growth companies are actually there? We should be actually having a piece of these companies and not just be limited in Malaysia, yep, or vice versa in any country. So trains us to be more in the market and being able to capitalize on bigger events. If we are just limiting to ourselves to one market, we're not really seeing the bigger picture. If we think overseas, we can actually see where the entire supply chain, how it's run, basically how it's run. Yep. So invest overseas. That means putting our money in companies that serve larger markets, capture huge TAMs. It's all about total addressable markets, right? If we are investing in high growth companies or companies that have the ability to go branding, to be building their own brand and serving huge TAMs everywhere in every country, that's where our money should be. We should be owning a piece of those businesses. Yep. Focuses on R&D and optionality. That means having the option to actually grow, bringing more shareholder returns, growing their own business, building that brand itself, right? Invest heavily onto their own branding rather than their own personal gains. That's where we should be having our money at. Yep. So that means, companies that starts with a T, ends with an A, and S little in the middle. Yep. Wink, wink. Those are the companies. Companies like Catel, Grow, Google, Apple, SoFi, Palantir, and the list goes on. Again, please do not treat this as financial advice, but these are the sort of winners that I have my hands on, and I want to be owning more of these, businesses. Yep. Now, number 4, create our own luck. I don't know how important is this. I wish I knew this, and this is more of common sense, but that's how it works. The stock market, if we were to earn money and if we were to profit in the stock market, it's not about just sitting our asses down and just researching. Anyone can do that. Everyone can do that, right? It's all, we have a keyboard, we have a computer, we got a mouse. Okay, we can do the work. But it's much more to that. If you want to be actually having a better edge than other people, it's more of creating our own luck. And what do I mean by that? What I mean is getting our asses off, talking to people, talking to the right people. Even if it's the wrong people, it doesn't matter. We make mistakes, right? Spending our time, just basically investing our time, investing in ourselves to be creating our own luck. And what I mean by that is by talking to more people, increasing the network, right? Getting off our asses and expanding it, exchanging ideas with like-minded investors. So as you talk more with people, we are creating our own luck. As we talk more with people, we know what this person actually is interested in and what is the stocks that they are looking at. How are they growing their portfolios? We should be looking at, people who has already done it, have been growing more than, 1,000% for the X amount of years. How do they do that? Is by holding great businesses, whatever, right? So we should be creating our own luck and not just be, expecting that the stock market is actually a gambling tool that can give you fast gains, right? So, a hold since 3 months and still no profit. Where's my Lambo? It doesn't work that way, right? For those of you that have just started in the stock investing journey, now you know that it's hard work, right? So 2020, 2021, there's the whole euphoria that, okay, we can all make money in the stock market easily. You know, whatever tools coming, crypto, we got NFTs coming in, and maybe there's still a trend, but I'm not trying to say don't invest in that. I'm trying to say suddenly all of these, stocks, meme stocks especially, you got GMEs, you got AMCs, all these stocks suddenly come in, and that's where it flies 100% in 2 days or 1 day, and we thought that, okay, we are unstoppable. We can definitely make money in the stock market. It doesn't work that way, right? It's all about, behind those stock tickers, there's a business. Behind those business is management. So get to know that management. Get to know them. Talk with people. Talk with analysts. Have your own fund. Talk with fund managers, right? Talk with people who are like-minded, who actually share. Join communities, right? That's what the Academy community is for. We share our ideas. We talk about them. We actually share our trading and FATA ideas. So people want to be millionaires, but they don't take action. They don't take action, right? I always call that, and part of creating our own luck is I call it the 100K lunch. So all it takes is to be having lunch with, let's say, your analyst or fund manager. You switch ideas, right? You share ideas, and there's a stock that they recommend. After they recommend a stock, or have a look at it, you do your own due diligence, right? You do your own due diligence. You research on the stock. You build your own convictions. You invest on it. You profit 100K. The lunch is practically worth 100K. Does that make sense? So basically, that's what I look at it. That's what I tell everyone. Yeah, I'm creating my own luck by talking with more people. I go play basketball, right, during a basketball game, and I'm talking to people actually sitting on a bench. Well, I'm not that good at basketball, that's why I'm always sitting on a bench, but that's not the point. The point is I took that extra step to get my ass off and just be rapport-ing with people, and I found out, okay, you're in this industry, cool, I'm in this industry, let's talk more with stocks. So that is potentially a 100K gain, right? Again, 100K. If it made you lose, it doesn't matter. It's your, we have to take responsibility because we have to do our due diligence end of the day. Yeah. So create your own luck, right? Rapport with company management. That's always the best because, they have good, this could give you an information edge that no one knows because firsthand. Also rapport with like-minded investors, join communities, share trade ideas, and stay hungry as fuck. Yep, stay hungry because there's always gains in the market, right? It doesn't matter if you lose money, the market is always there, and we should always be hungry. Yep. Now, number 5, the last one, share your ideas and improve from them. Yeah, so this is a bit relative to number 4, but share your ideas. You'll never know when you share more ideas, you're actually attracting more ideas to come back because hopefully, I'm pretty sure, very likely, that the other person that you share with will likely share their ideas of how they got money and how they earn back with you. So if you share and you give more, you'll eventually also take more, and that's the concept. That's how it works. So share and give, not only take. And basically, as for me especially, right? I wished I started writing publicly earlier, because when I share my ideas publicly, it makes me double check my work. It makes me think, okay, it makes me more responsible. Yep, it makes me more responsible. It makes me think that, okay, I should be thinking carefully before I really share this idea, because my concept is that for Academy is all about, improving and empowering ourselves together to be growing our net worth through stocks. So before I actually share this idea, I'm going to be thinking, okay, is this really a good idea? Because if it's not, then I'll be responsible, and I don't want to be I want to be responsible. I don't want to be, bad in terms of my image. So, okay, I really got to make this right. Yeah, so sharing my ideas help me think more clearly, tweet it out, share it on a platform, Facebook, whatever it is. We should be doing that earlier. Yep. So it doesn't matter if we get it wrong, because the market is always there for us. We can actually make money. So don't be afraid that, if you lose 50% in in this particular account, don't be afraid, because you're going to get it back eventually. All it takes is time. All we got to know is learn why we lost, how do we lose it, and how we're going to improve from that. Yep. So the market is always there. You can always gain 30% in 2 weeks, right? I'm not trying to encourage fast trading, but that's what the market can allow us to do, and especially if we capitalize in the right timing or the right stocks in the right events. Yep. So the markets are ever changing. We have to always improve ourselves. The markets are always changing. PayPal, which is quite a blue chip stock per se, can go down 25% simply because of weak guidance. Now the question is, was it already inflated since 2020 back then? Having a PE of 40 doesn't work anymore. It should deserve a 15 PE on this lower growth stock, high in the S curve. We never know. But my point is, the markets are changing. 2020 markets, GM meme stocks are coming in, NFTs are coming in, crypto is coming in. How can we capitalize on these different stocks, these new stocks? The markets are changing, so should we. We should always be adapting and live on and improving ourselves. Yeah. Now, also, the last bit before I end this video is what is the sort of intelligence that we should be building to be improving ourselves? I wish I knew this back then, right? It doesn't mean if you have high IQ, if you're a smart ass, if you're a good mathematician or went to business school, it does not mean that you'll make it in the stock market. To make it in the stock market, we need a different form of intelligence. We need to be willing to learn, being patient, being disciplined, and being a realist, right? We do not fall in love with the stock. We are a realist. We look at fundamentals. We look at the management, whether they're good at it, right? Eventually, you'll love the company if you're building high convictions, but that's the concept. Being disciplined in portfolio strategy, portfolio management, everything we talked about. Being patient to capitalize on weakness is a high level skill that we need to have. I wish I knew this because I'm never patient. I'm very impatient. Yep. And willing to learn. There's so many things to learn about energy, ONG, different sectors. Why do these? How does this particular sector actually affect another sector simply because of supply chain disruptions or supply chain overall? Right, commodity super cycle. We are learning things literally every day. Make sure we do too. I wish I knew that last time, and hopefully we can actually emulate that. Right. So the concept is to be holding great businesses, because that's what it is. Behind that stock is a business. We should be holding it. I was lucky, and because I already knew the concept of investing. Back in 2019, I was losing 50% on Tesla, but I'm still holding a great business. I've done my due diligence. I've done my fundamentals. I've been looking at Elon Musk and what's he doing. So the concept is the stock market tests our emotions. Fundamentals are tending to get better eventually, and the share price is just to F us up to tell it and test our emotions, test our mindset. Yeah. So hopefully you guys got some value out of this today. These are the 5 things that I wished I knew back then when I started my investing journey. Smash the subscribe button if you haven't, smash that like button if you enjoyed this video, and I'll see you in the next one. Thank you.